So what happened to SVB? In this video, I'll talk about the main causes of this collapse, what is happening to other banks, will SVB receive a bailout, what will happen to their customers, can this happen to your bank, and some actions you can take. Let's dive in. So before I talk about the reasons why this collapse happened, I'd like to give a little context to their company history because it really relates to a major lesson learned in this case. So in 1983, Silicon Valley Bank was founded. They originally started what looks like a normal or traditional lending institution serving multiple industries. They soon after, as that same year, they decided to focus primarily on tech, getting involved in venture capital. They experienced some pretty solid growth in 1987. Just a few years after they were founded, they actually went public. Then in 2000, their share price went from $20 up to $70. That same year, dot-com bubble, they pretty much were cut in half. Their share price went down 50%, along with a lot of other tech businesses at the time. Now, they did recover, but this is an interesting fact. As of 2021, get this, about 50% of the VC-backed companies in the US, this is tech and life science, 50% are actually backed by SVB. They're highly focused. They have a huge portfolio in tech. Now let's talk about really three main reasons why this collapse happened. And there's a few other reasons, but these are the easiest reasons to understand and really the major causes. So number one, no cash. Banks generate their revenue based off interest rates. They lend money to businesses. Those businesses will pay back the loan and they have to pay back plus interest. And when you're lending to hundreds and thousands of businesses, you can make some really serious cash. Well, what happened is with rising interest rates, the amount of deposits into the bank and the amount of investors, like we're talking large institutions and venture capitalists, putting money into SVB, that slowed down. If the money in slows down, that means the money out slows down. And that money out is where they make their money, is they're lending out, getting paid back plus interest. So that's number one, no cash. Number two, there's a lot of people, of course, exiting at the same time. They're not only withdrawing their savings accounts, but they're actually selling their bonds for a loss. So, and I'll just kind of talk about bonds here, try to keep it in simple terms. So a bond, if you don't already know, it's a situation where you can go to a bank, you can buy a bond, and in this case, you are the lender. You kind of act like a bank in this case. You are giving the bank money, and those bonds could be municipal, focused on the city, or they can be government. And the city, government, whatever, they can use the money to maybe build a new facility, new building, maybe invest in tech, stuff like that. And you will buy that bond for a set term, a maturity. It's called a maturity date, and then you're receiving a coupon rate, which is the rate of return. So simple math, let's say I put $1,000 in, or I buy a bond for $1,000, 10-year maturity, I hold it for 10 years at a 2% rate. That means every year I'm getting paid 2% or $20. Then at the end of the term, the 10 years, I get that $1,000 back. What happens is interest rates and bonds have an inverse relationship. When interest rates go down, bond prices go up. Flip that equation, you have interest rates going up like they are right now, bond prices go down. What that means is in the middle of the term, if people sell, they sell for a loss. And I actually want to walk you through a little example here. I've got an article kind of detailing everything I'm talking about here, but I also have a link to a bond calculator. And I just want to kind of run through a little example. So let's say, just using nice round numbers, we buy a bond for $10,000. And then within this article, I found that the interest rate was 1.79%, and it's, because it's increasing, it went up to 3.9. So we're going to put in 1.79 and 3.9%. 1.79 is the coupon rate, and then the 3.9 is the current rate. So we'll go 1.79, 3.9. We'll use 10-year maturity, and we will set this to annual. Let's go ahead and hit this. And you can see here, check this out, you're not going to get your $10,000 back if you sell midpoint you're getting 8,200 back. So that's almost a 20% loss. People don't even care about the loss. They just want their money out. So that relates to those 2 points. People not depositing, they're taking their money out and then selling bonds for a loss. It really leads up to the third point, which is a bank run. In this article, I have a link to Investopedia, gives a little more long-winded explanation, but essentially everybody's taking their money out of the bank at the exact same time. And that's exactly what's happening here. So those are the 3 main reasons. We're going to lead up to a major lesson learned here in a moment. So what other banks are collapsing? One of them is Signature Bank. They have a portfolio in real estate, but they also made some big plays in crypto. Risky place to be. So to back up a second, you got SVB, highly focused on tech. You got Signature. Yes, they have real estate, but they also became more involved in crypto. Crypto's highly volatile, a lot of emotions. A lot of people started selling and exiting at the same time, same situation. People tried to get this, withdraw about $10 billion on one day. Now that bank is closing up. A third bank, Silvergate. They are completely focused on crypto. Again, another focused industry. They started selling out at the same time as well. So another bank run. And then I found an article here on CNBC talking about other regional banks that are, yes, they're diversified in multi-industries. Their share prices are going down. This was as of March 13th. As of the 14th, it looks like there's been a slight correction. Now, in this case, it doesn't mean people are selling out. It just means investors are just selling the stock. So it's not necessarily a bad sign. Let's keep going here. We'll get to some of the actions you can take. So one big question is, will SVB receive bailouts? I found an article here from thehill.com. President Biden said verbatim, no losses will be, and this is important to point, no losses will be borne by taxpayers. In other words, we as taxpayers are not going to pay for this. It looks like the money, the people who put their money in the bank is going to be paid out via the insurance fund. The FDIC, you're insured up to $250,000. So that leads up to this next question. What will happen to those SVB customers? Those who have $250,000 or less, they will get their money back. If the money is over, that's in question right now. So we don't know what's going to happen. I tell you what, I'd be scared if I had more than $250,000 in that bank. I'm not sure if I'm going to get it back. We'll see what happens. All right, so another question that a lot of people have is, can this happen to your bank? So as we saw, SVB is focused on tech. Signature, yes, they have real estate, but some crypto. And then Silvergate, all crypto. In most cases, you probably don't have to worry if you invest in like a really well-established, well-diversified bank, even a regional bank that's well-diversified, maybe a credit union. Same thing like a regional bank, it can be diversified. The major risk comes with banks that are highly focused, because when you're in one sector and that sector starts collapsing, everybody's going to bank run. They're going to start pulling their money out at the same time. So again, keep this in mind. If you're with a safer bank, larger bank, you should be okay. But if you're something more focused, this might be the sign to get out and move to something more reliable. Some people have asked about, this leads to another point, is some people have asked about the 2008 housing crash. Does this relate? So yes, there were banks that went under at that point, but it was for a different reason. So for context, at that time, this is before 2008, people were receiving loans like mortgages when they should have not received them in the first place. They had really unreliable income streams, maybe very low income streams, and they shouldn't have received a mortgage. And what these institutions were doing is bundling all these junk mortgages into securities that investors could buy. It was really driven by greed. And what happened was the collapse happened, and there were several banks, well, more than several, that went under. So the first, this was the biggest, it was Washington Mutual. They collapsed. Soon after, you had some major investment banks, Lehman Brothers and Bear Stearns fell soon after. And then get this, between 2008 and 2015, more than 500 federally insured banks also collapsed. These banks were involved in selling these mortgage-backed securities. So can this happen? Could we see a major fallout? My opinion is yes. We could see more banks fall, more banks collapse. But in my opinion, it's going to be banks that are highly focused on like one industry, whether it's tech or crypto. When one industry collapses, the whole industry or the whole bank can pretty much collapse. Everybody's going to start pulling their money out at the same time. So the big question is, what should you do? Now, you can do anything you want, but this is what I would do. So number one is don't freak out, especially if you have your money in a well-established, large bank that's well-diversified. I use JP Morgan Chase. There's other big banks out there, Bank of America, Wells Fargo, the list goes on. If you're with a regional bank that's well-diversified, you should be okay as well. Same thing with a credit union. But if you're in a highly focused business, again, tech or crypto, you could be in trouble. I would start taking my money out, put it in something a little more reliable. Now, point number two, keep an eye on the Fed. So there are people who are upset with the Fed, Jerome Powell, for increasing interest rates, which, yes, that has been a little bit of a cause here to, these banks collapsing. But it's not part of the big picture here. We have to keep increasing interest rates to lower inflation. For context, we learned our lesson from this. 1980 to 1982 is the Great Global Recession. Inflation rates in 1980 went up to close to 15%. And multiple strategies were tried and they failed, but there's one strategy that worked, and that was increase interest rates to drive down inflation. It worked. We kind of went through a 2-year time period approximately with that great global recession. So for context, inflation was up to 9% in June of 2022. As of February, March of 2023, it's gone down to 6.4%. So we're moving in the right direction. That's great. So what needs to happen is, unfortunately, some people push back on this, but another rate hike probably needs to happen. I was just watching a few videos on CNBC as of this morning, March 14th, talking about another 0.25% could come. So what? We have to get out of this. The only way to do this is keep raising rates. But eventually we will get out. We've recovered from other recessions, bear markets in the past, full transparency as well. Over the last 100 years, we've had about 19 bear markets / recessions, and they last about 9 months. So right now, I think we're at about month 14th or 15th, something like that. A little longer than average, which means we're going to see a correction. It's just a matter of time. All right, third point, keep an eye on other banks. As mentioned, we've seen these three, SVB, Signature, Silvergate. There's maybe a few others kind of collapsing as I speak. But the lesson learned here is they're highly focused on one industry. And that really leads to the fourth point, which is the big lesson learned, is if you have a business that actually takes people's money, you're acting like a bank or a brokerage, you're taking people's money, you want to make sure you're well diversified. I'm seeing more of these new tech apps that are like, it's like a new lending or investment application, and you actually connect your bank account, make deposits. They lure you in with these higher like savings rates, giving you something like maybe 0.25 or 0.5% greater than your current bank to bring you into the system. Be careful. If they only invest in one sector, the rug could get pulled out and that bank could collapse. So although, yes, shiny object, they can lure you in with those nice rates, it can be a risky place to be. I do suggest, and this is what I'm doing, keeping my money with a large, safe institution. So I hope this video gives you a little context on what happened and an idea of what actions you can take moving forward. If you have any comments, please leave them below, and I'll see you in the next video.